Welcome to another episode of the Know Better, Do Better series. Chloe Moore and myself, Lauren Williams, have been bringing you all of the financial gems over the past, I don't know how long it's been, but all of 2021, we've been doing this series. And at the top of every show, we like to do what we call Trends, Taxes, and Tea, where we give you the latest trends on how to save more and pay less, or share some current event that has to do with money. So we generally always lean toward that current event, and Chloe is amazing at finding us all the trends, taxes, and tea. Chloe, what do you got for us today?
Yeah, so a couple of weeks ago, there's a company called Basecamp. It's a tech company. It's basically project management software, and so this is a little tech tea. But basically, a couple of weeks ago, the CEO of Basecamp and the co-founder, he released a controversial blog post. And so it outlined a series of changes in the company. One of the big changes that stirred up a lot of controversy was that he banned political and social discussions at work. And he eliminated committees, including the recently formed Diversity, Equity, and Inclusion Committee, among a lot of other different changes. But basically, the announcement sparked a lot of outrage on social media. Even employees were upset about it and kind of blindsided with the announcement. And then there were some reports about kind of the reason why the controversy started and why he released the statement, and that just did not help the situation because there was a lot of sketchy stuff going on behind the scenes. But basically, after that, the company founders, they decided to have a meeting with the employees, and they said, okay, we're going to double down on what we said. And if you don't like it, you can leave and we will pay you a severance package. So by the end of the week, about a third of the company left.
1/3 of the company?
Yes. Now it's a small company. I mean, it's like 60 something employees, but yeah, a third of the company left.
To be man down 20 people at the end of a week should be sending a pretty clear statement to that employer. For sure.
Yeah, definitely. And so, one of the reason why I wanted to bring this up today, we're talking about investing. We're doing our a 3-part series, and this is part 2 of the investing series. But, the reality is that, we as employees, if you work for a company, you, especially if you're in a marginalized group, whether you're a woman or person of color in the LGBTQ community, you don't necessarily have the privilege of just accepting the fact that your job is going to be a safe space. You might work in a toxic environment. Your boss might do something that, completely affects, you and how you show up at work. And so if that's the case, you need to have some money set aside. These people who were able to leave, even with the severance package, that's a privilege to be able to leave your job, whether you have a severance package or not. If you have family to take care of, if you have people depending on you, it might not be an easy decision. And some of those people who were left at the company might not have been in a financial position to leave, even with the severance package.
That's a good point. I hadn't really thought about the people that stayed. Maybe they didn't really want to stay, but they're just like, ooh, but this paycheck though.
Right. So yeah, that's a risky thing to do. So just, that's part of the reason too, in addition to, investing and saving for your future, you might also want to save, just to be able to leave your job if you need to, if things get really bad. And it's similar with relationships.
Yeah, I think you are 3,000% right. So she's talking about the rainy day fund, guys, the emergency fund, the savings on the side, some people call it the FU fund. You definitely need to think about that. And when I think about relationships, I've heard tons and tons of stories of people who were stuck in toxic situations, really wanted to get out, but couldn't figure out how to get out of the relationship, or have even been surprised in a situation where, hey, my spouse is leaving me with my 2 children. I've been staying at home the whole time. I don't have an education, maybe even in school trying to get an education. Maybe that was something you were, had goals or aspiration of doing. So think about the timing of if somebody springs something on you that you hadn't expected to come, or if you're in a situation where it's like, oh my goodness, I cannot spend another day, another minute, another hour in this situation, and you don't have any savings. So we want you to have that FU fund, that emergency fund, that rainy day fund, and we want you to make sure that you're properly preparing for yourself so that you are good to go if you need to go.
Yeah. And then longer term, in addition to that, longer term, the purpose of of having, these investments and assets that you build up over time is to be able to get to the point where you work because you want to and not because you have to, and that's really the ideal situation. When, we say retirement, but a lot of us who are younger don't really see ourselves quitting at age 65 and moving to Florida and living in a condo. I
definitely don't see myself
right. But yeah, it's like the traditional sense of retirement is not the same, for younger generations, but we still do want to get to the point where working is an option. And that's really the ultimate flexibility, is to manage your time and do what you want with your time.
Yes. And the way that we do that is investing those dollars that we're getting now. So in the last episode, we covered how to get started with investing, the types of investments that exist, and then how investing fits into your overall financial plan. Today, we're going to be talking about the types of investment accounts that exist. And so I just want to stress to everybody that this is Investing 101. If you feel like you got investing on lock, these might not be the 3 episodes for you. But for us, we know that there are so many people out there that don't know the basics. And, you might think of this as what some people say, like investing for dummies. And I'm just like, no way, no how. We're calling this investing for beginners. So why does that matter? Why am I going off on this little tangent? Because I think it's important that we watch our words and that we guard our minds and our words, because our words become our actions. So if we call it investing for dummies, you start to think that you're a dummy and that, you don't know these things. And the whole point of all of this is to gain literacy. And I actually know someone who was like functionally illiterate for much of their childhood, but is brilliant. I mean, absolutely brilliant. And one of the lessons that I learned from being in the midst of that person is that, being illiterate does not make you stupid. So we really need to make sure that we watch the words that we're using. And we need to say like, oh, I'm not literate in this area, but I'd like to become literate. We are not dummies. We are all very intelligent people that are working to get smarter. So without further ado, let's talk a little bit about the types of accounts, and let's get more into these topics that are investing for beginners.
Yeah. So the first thing I wanted to cover was there's 3 major categories of assets or investment accounts when you think of types of investment accounts. And we wanted to clarify this because there's so many people that come to us and they don't understand the difference between them, or there's certain rules, and so. But basically, the 3 types of categories are taxable investments, tax-deferred investments, and then tax-free investments. And so we'll kind of break those down a little bit. So the first one, taxable assets, that's just a traditional brokerage account. So think of that as an account that you would open up, on your own in your individual name. And so with those accounts, you pay income taxes on the dividends or interest that accrue in those accounts. And then you pay capital gains taxes on any growth or appreciation when you sell those assets.
Okay, wait, just one second. So we got to pause and break it down, because like one of the things I wanted to mention too is that the brokerage account is the thing that we've seen quite a bit of people opening over the last year. So the pandemic came. People, saw stimulus money coming in, saw PPP money, or, various funds for various reasons were staying at home and had more money. And they're like, I got to start investing. I got to do something responsible with this money. And this is the kind of account that you may have opened, not really knowing the name of that account. But you just said something about paying dividends or interest and capital gains. So can you just like pause for a second and tell us like what the difference is? How do those things come about?
Yes. So if you have, just think of like a bank account as an example, or a certificate of deposit or high yield savings account. Those accounts, or even bonds, or some kind of fixed income investment. So those types of accounts pay interest. So you receive a certain interest rate that they pay you for having that account or having that type of investment. And so those are things that you pay taxes on that interest, generally speaking. And then dividends, there's some stocks, there's some funds that they pay dividends to the people who hold that stock or that investment. And so for dividends and interest, you pay taxes on that income, whether you take it out of the account or not. You can reinvest it, but you're still going to pay taxes every year on that amount. And then the last term is the capital gains. And so it could be a capital gain or a capital loss. Because investments do go up and down. And so basically, if you buy an investment, let's say for $100, and it goes up to $120, then that $20 gain, when you go to sell it, if there's a $20 gain, you pay taxes on that amount. And then same thing if it's a loss. If you buy something for $100, if you sell it for $80, then you have a $20 loss. And so those are just kind of things to understand how those work.
Yes, yes. Thank you for breaking it all down. I think it's so important to understand that there's multiple different moving pieces when it comes to investing. So sometimes people get a little bit overwhelmed when they, hear the word investing. Is like, I don't even know, what exactly this thing is. But they go and they open that brokerage account because their friends are investing in, so-and-so is doing it. And I got to make my money make money is the thing that we hear all the time. But it's really important to understand those baseline terms before you kind of jump off the ledge because, they do matter and they are going to affect your overall financial situation.
Yeah. And then with the capital gains, that's something to be careful about. The capital gains taxes, it could be lower or higher than your ordinary income tax, depending on if it's how long you've held that investment. If you've held it for less than a year, if you've held it for more than a year. So, there's a lot of people on social media and everywhere teaching you how to invest and day trade. If you're buying and selling things on a daily basis and you're not holding those investments long term, which is at least a year, then you're going to have to pay more in taxes on those gains. So that's something definitely to pay attention to.
Yeah, that is something I see people bump into all the time. It's like, well, I'm learning this thing. I'm doing this day trading. So-and-so is teaching me how to trade. And as you go through that learning process, you're doing quite a few transactions. So one, that there's a transaction fees that you need to be mindful of because those are diminishing your returns. But then two, that like you said, if you're selling and buying and selling all the time, it's chances are you're going to have what we call short-term capital gains, which, could be the equivalent of like ordinary income, where this effectively becomes like a job for you. If everything you're doing all year long, even if you make money from it, ends up being in a not favorable tax situation, it's similar to a job. And so a lot of people think that, like you said, this is money on the side. It's passive income. There's all these terms, making my money make money for me. You have to be aware of like how you'll be taxed accordingly based on what you're doing in your investment accounts.
Yeah. And with this being tax season, we heard a lot of horror stories from fellow financial advisors, CPAs that we know who received these tax documents and clients were shocked that they owed, $20,000 in taxes or some crazy amount. And you see all these different trades and accounts and so it's something, that you really need to watch out for and make sure you understand what you're doing before you get into trading.
For sure. All right, let's talk about this thing called tax deferred. So we just talked about taxable. Those are things that are taxable annually, but there's this thing called tax deferred. How does that work?
Yeah, so tax deferred is the second category. And so that's traditional 401ks and traditional IRAs. So with these accounts, basically, you receive a tax deduction on money that goes in the account. So, for example, if you put $5,000 into a traditional 401k or traditional IRA, then that reduces your taxable income that year by $5,000. And so that money goes in, you get a tax deduction on the front end. But since that money's never been taxed and it's going to grow, when you take the money out, then you pay ordinary income taxes.
Okay, but when can you take the money out usually for these accounts?
Yeah, for traditional 401ks and IRAs, it's typically at retirement age or close to retirement age.
59 and a half, y'all. 59 and a half. So another thing that people bump into all the time is, needing the money prior to age 59 and a half. So that means you put money in here, but you maybe didn't do what you were supposed to do out with the emergency fund or something came up. Life happens to all of us and you needed to pull from here. If you pull from these accounts before 59 and a half, you can expect to pay taxes and penalties. Now, there are some instances where you can actually take a loan, but if you take a loan, that means money is out and you're expected to put it back in. And while that money is out, that's money that can't work on your behalf while, it's supposed to be doing its thing in the investment market. It's doing some other job that you've now given it. And then it's got to play catch up. So you will be affecting your retirement if you pull money out. So that's just something else to be mindful of.
Yeah. And then the last category is tax-free assets. And so This is Roth 401ks, Roth IRAs. And then I also throw health savings accounts into this bucket, or HSAs. And so basically with Roth 401ks and IRAs, you contribute after tax money. So like your money that you have from your take home pay, that would be money that you put into a Roth IRA. And so these accounts, you have to follow certain rules, and we won't get into that, just for sake of time. But if you follow certain rules, you can withdraw the money from these accounts tax free. And so HSAs, they're a little bit different. They kind of have a triple tax benefit. So they're kind of the best of both worlds. I think they're better than Roth. But basically, with these accounts, you receive a tax deduction for the contributions, and then if you use the money for qualified medical expenses when you withdraw it, then you can withdraw the money tax free. So you get the tax deduction and the tax free withdrawals.
Ooh, deduction and tax free. So that works out well. So it's kind of like tax deferred and tax free wrapped in one when you do the HSA sort of deal. Because you could also like leave the money in there for a while if you don't end up having health expenses and take it out later, like when you get to retirement age as well. So it's effectively like a little baby retirement account. You shouldn't think of it like that, but it actually could do that work for you as well.
Yeah, and I tell people like you can definitely think of it as a way to save money for medical expenses in retirement. If you can afford to put the money in there and continue to pay for your medical expenses out of pocket, then that is a great savings vehicle. And so, a lot of people don't understand the difference between HSAs and FSAs, which is a flexible spending account. With HSAs, your money rolls over from year to year, and with a flex spending account, you have to use it or you lose it. And so I'll put an article in the show notes that explains that in a little bit more detail.
I love it. I love it. I love it. One thing I wanted to kind of hit on was kind of the great debate of pre-tax versus post-tax. So all the rage right now is all things Roth. Everybody's putting their money into the Roth. And I think it's particularly trendy among our age group. I feel like the pre versus post-tax is like one of those things where you really have to do what's going to make the most sense for you. So one of the things I do a lot of consulting on is student loan planning. And with people who have federal loans, it's really important if we're going to go for what we call taxable forgiveness to keep your AGI as low as possible. And so when I say AGI, that's your adjusted gross income. The way to do that is to put money away on a pre-tax basis, which is your regular 401k, your regular IRA that we just talked about. There's also two other accounts, the traditional IRA, the simple IRA and the SEP IRA as well, depending on if you're an independent contractor or you work at a small company. But the importance of this is when you put money away on a pre-tax basis right now, you save money on taxes right now. We don't know what's going to happen in the future. So people who are hardcore Roth believers say, when we get into the future, the government's going to raise the tax rates. They're going to be so high that I'm just not going to be able to afford it. So I'm just going to pay my taxes now and never have to worry about paying taxes later. Now on the other hand, like you said, you don't know what tax rates are going to be in the future. So what if we got to age 59, 60 or whatever, and we wanted to pull some money out and tax rates are similar to what they are now? Now you can use a strategy and say, I only need to take maybe $10,000 or $20,000 out of my traditional account. So I'll be taxed on that, but I'll be taxed in the lowest bracket. And I'll take the rest of my money out of my after-tax account, so my Roth account. And between those two, I now have a really good situation where I paid a lot less taxes and I have enough income to live off of during my retired days. So I think it's something to really think about is, by not saving yourself any money on taxes right now, you do yourself a disservice. Also, we can't tell the future. None of us have a crystal ball. So you're betting against the government saying they're definitely going to raise tax rates, and betting against yourself saying that you're not going to be in a lower tax bracket, or you're not going to be able to use a strategy to be in a lower tax bracket when you hit retirement.
Yeah, and I always tell people it's ideal to have an investment portfolio that includes all three types of assets. I mean, that's the reason why we wanted to break it down is, if you have tax deferred assets, if you have tax free assets, and if you have brokerage accounts, then you have three different types of accounts that you can pull money from whenever you're ready to pull it out in retirement. And you can kind of create your own tax bracket. If you're starting with zero income, which most of us will be because we can't really count on Social Securities. We don't have pensions, any of that other stuff that's going to create income. You're essentially able to kind of build your own tax bracket and pull money from different places where it makes sense. So So yes, it's ideal to have assets, in all three different types. Because another issue I see is people do, just put money in their tax deferred accounts and in their traditional 401ks, and then they have no other assets. And so then that's going to put you in a bad situation because all that money, comes out as ordinary income. But just make sure that you work to try to have that combination. And so I have another article that we'll put in the show notes. I talk about, whether it makes sense to do the traditional 401k or the Roth 401k. And I talk a little bit more about each of these different account types.
Yes, Chloe is a writer, everyone. So if you like to digest information in various ways, and one of them is by reading, you should definitely check out most of the stuff that Chloe has written. It is all over the place. You can find it on LinkedIn. You can find it on her website. Like I said, it's in our show notes. So make sure you check out other stuff there as well.
Yeah. And then the last thing we'll say before we move on to the next section is, each of these accounts have different rules. There's income limitations for some accounts. There's contribution limits, taxes, penalties for withdrawals. So just, make sure that you understand the rules when you make contributions, or if you're rolling over money, you might have an old 401k from a, old company, or you might be, combining accounts or consolidating to make your life easier. But, you need to understand what types of accounts you have, and so that you don't make any mistakes or create, some unintended tax consequences.
Ooh, that is a good one. That is a really, really good point. Because you're right. So many people have old accounts that they kind of leave behind, leave this trail of like 3 different jobs. And now you found your forever job, or what you feel like is going to be a long-term situation. And you left all those things kind of hanging out in the balance. So rollovers are, rolling them into either what we call a rollover IRA or into your current 401k or whatever is available to you at your current employer. So to be mindful of that. But like I said, also that if you leave them hanging out, maybe you can't put money directly into a Roth, because not everybody can do it. Yes, it's easy to kind of click some buttons and have a traditional or a Roth IRA set up today. You can even do it tonight. You might be driving and opening one right now. However, there are rules about who can contribute, how much they can contribute, and what income you have is how it's going to allow you to contribute. So you have to take all that into consideration. And sometimes people don't know that your rollover IRA could affect the contributions to your Roth IRA. It's like, so make sure you kind of nail that down before you get clicking buttons.
Yeah. So the next section we want to talk about is just how to prioritize between saving, investing, and paying off debt. This is one of the number one questions that I receive when I'm speaking with people. And there's so many different types of accounts, like we just mentioned. So people just want to know, like, what do I contribute to first? We'll talk about some general guidelines. Of course, everybody's situation is going to be a little bit different, but we feel like this is kind of a general guideline for how to prioritize. So the first type of account that we recommend contributing to is your 401k, and so typically up to the employer match if your company matches that. This is free money. So as an example, let's say if you contribute 3% of your income into a 401k, your company will pitch in a 3% contribution on your behalf, and so that doubles your contributions right away. So that's money that you should always take advantage of it. It's free money, and it's a way to double your money right away. So that's a no-brainer as to contribute up to the match.
But what if my company doesn't match? Like, should I still put money in this 401k thingy? Like, I don't see. Like, if I don't get the free money, maybe I don't want to put anything in here.
Yeah, that's another question that we get all the time. And so we still think it's important to contribute to a 401k, even if your company doesn't match. Because again, we talked about just reducing your taxable income. And this is money that, the purpose of a 401k is for you to take control of saving for your retirement. And you can do it in a way that helps to reduce your taxes today. So regardless of if your company matches or not, it's important to contribute to this type of account.
Amen. Hallelujah. You have to save for your retirement. The match is something that is an extra employer benefit. While tons of employers have it, those that do not are still doing you a service. It is an employee benefit in and of itself to have the 401k, because there are lots of companies out there now that don't even offer you a way to save for retirement. So please, please, please put some money in this thing. Get ready for your retirement. And one other thing I'll say about the match is the max is not the match. So the MAX is not the match. And I think we've probably covered it in a few other episodes, but no time like the present to say it again. The maximum amount that can be put into a 401k is $19,500 presently. The match is, like you said, the amount that your employer will match, which is, like you said, typically 3 to 6%. You can put 19,500 all the way, all day, like I said, even if there is no match. So your goal is to try to fill up that account so that after that's full, you can move on to the next thing, which has nothing to do with a match or not.
Yeah. And so the next category is kind of 3 different buckets. The first one is your emergency fund, funding that, paying off any high interest debt, and then short-term savings. So I would say, if you don't have your 401k up to the match and these things in place, you are not ready to open up your Robinhood account or your Coinbase account or all these other things that we talk about. People kind of get these steps mixed up, and they don't have an emergency fund, and they have credit card debt, and they're trying to invest in the market or day trade. So we want to talk about these 3 accounts and just why this is important. But first of all, emergency funds, we talk about this all the time. They cover unexpected expenses, a job loss. It prevents you from blowing your budget or getting into debt if something were to happen. And like we mentioned at the beginning of the episode, it can also serve as money if you need to leave a bad situation at work or a relationship. So I would say for an emergency fund, aim for at least 6 months of living expenses is kind of a good rule of thumb. You can go a little bit lower or a little bit higher depending on your situation. But that I know that seems like a lot, but if you can just start with saving 1 month of living expenses and just build from there.
Yeah, I think a lot of people get really frustrated because they're like, 6 months. Oh my goodness, that's like half a year. But you just have to start somewhere. So, one of the popular talking heads out there says, like, get your first 1,000 in the bank. And while, like I said, we can't stop there, I think it's a good thing to think about, like, okay, where do I need to go next? All right, I got 1,000. Let me get to the 1 month mark. I got 1 month. Let me get to the 3 month mark. And then kind of set those small intermittent goals along the way versus focusing on a big goal that may make you feel like, oh, I'm never going to reach it. And so why even try?
Yeah. And cash is king. I mean, just remember that nobody ever says you made us save too much money.
Never heard it in my life. Right.
Yeah. And it's like, I mean, you look back at last year, we had an unexpected pandemic hit. People lost their jobs. People were laid off. People had, financial hardships. And so if you didn't have that cash to fall back on, you might have been in trouble.
Mm-hmm. Yeah, so many clients were thankful that we had the emergency fund because, like you said, we go to 6 and sometimes even 12, depending on what your situation is, the volatility, the kind of risk that you're taking on. So definitely not a bad thing to have a lot of savings.
Yeah. And then the next category is high interest debt. So credit cards, personal loans, things that have a really high interest rate. You want to make sure that you pay those things off. If you're paying 10% or more in interest on any kind of loan, then, by paying that loan off, you're getting a 10% or more return. And so there's no investments out there that can guarantee you, a return on investment like paying off high interest debt.
Right. And a lot of high interest debt, like you said, these credit cards are like 29%. I see it all the time. I did see recently somebody with a single-digit interest rate, and I was like, wow, look at this on a credit card. That is definitely the exception, not the rule. So you want to be mindful of that as well. And what I usually recommend for clients is, let's say you go through your budget and you find an extra $500 a month. Well, just split it right down the middle. Put $250 in your emergency fund, $250 extra toward whatever debt. So you already got your minimum payment because you've done that in your regular budget, but now you got an extra $250 to throw toward it so that you're not sacrificing saving for yourself, but you're also paying down some debt.
Yeah, you definitely want to balance paying off debt with building your emergency fund. And then the last section is short-term savings. So, just think about any expenses that you would expect in the next couple of years, like 2 to 3 years max. But it could be a down payment for a house, or if you have a wedding that you're paying for that's coming up, or if you want to take some extended vacation or time off. You just want to make sure that you have money set aside for those things too. We talked about this before, but if you're investing, you don't want to put any money in the market that you're going to need in the next couple of years or in the short term, because if the market goes down and you have to sell when the account's down, that's not a good situation to be in. So
it's a terrible situation to be in. Imagine saving up for your wedding, putting it all in an investment account, and then COVID hits, and immediately overnight you got 30% of whatever you save has disappeared, and now you got to put your wedding on hold. I mean, we had to put our weddings on hold because of COVID anyway, but not a good situation. What I did see a lot with clients last year, though, was down payments. People who decided to put their down payment in an investment fund of some sort. And like I said, that did not go well because they're ready to buy and they didn't have what they needed. That's what prompted them to reach out to a financial planner. Like, oh crap, what do I do? Got some new clients as the result of a bad situation in that regard.
Yeah, and we definitely, we've seen the market kind of go up and up and up for a long time. We had a small dip last year, but that kind of people panicked a little bit. But at some point the market's going to go down again, and so just being prepared for that and making sure you have cash for those short-term expenses is a good situation to be in. So basically, just to recap, so far we've talked about 401k up to the employer match, or if you don't have an employer match, just contribute some amount, at least 5%. And then we talked about emergency fund, high interest debt, and short-term savings. So once you filled up all of those buckets, then the next bucket or next two buckets are Roth IRAs and health savings accounts. And so there's really no order for these. They can kind of be interchangeable, but these are the next two that I would say to focus on. So with the Roth IRA, you can contribute if you make less than $125,000 a year, and that's for this year. The number goes up each year. And if you're a couple, it's $198,000. So you have to make less than those amounts to be eligible to contribute directly to a Roth IRA. And then the contribution limit is $6,000 for this year.
So what happens if I make more than that? Like, I'm not allowed to do a Roth. I got extra money. Why can't I put my money in a Roth, Chloe? Like, I'm making bank. Like, so we'll get to that. There is a way to get money into a Roth if you make too much money. So we'll put that a little farther down on the list. And then the next category is the health savings accounts, or the HSAs. And so to be eligible to contribute to these, you must be enrolled in an HSA eligible plan. And they're typically those high deductible plans that you see. And so the contribution limit for that is $3,600 if you have individual coverage, and it's $7,200 if you have family coverage, which is yourself and a spouse, or yourself and children. And so if you can afford to, like we said earlier, consider letting that money accumulate and just continue to pay medical expenses out of pocket, because that could be a little retirement account for medical expenses. Do you have an article for this? Because I feel like this is something people need to read more about.
Yes, I know, it's like that's my new tagline. There's an article for that,
right? So we got an article for everything.
But yeah, so I explain that a little bit in an article, and we'll put that in the show notes as well. But yeah, so those are the next two categories: is Roth IRAs if you're eligible, and then HSAs.
All right. So because we were only doing the match on our 401k, now when I was talking a little bit earlier, I jumped the gun a little bit. I get excited, but now you can top off your 401k. So as I mentioned, that contribution limit is $19,500 for 2021. We like to think the podcast is going to go on forever in perpetuity, and somebody's going to be listening to this episode a couple of years from now. So it might be a new limit at that point. And depending on your income, you may be able to do the maximum and still have room for additional steps. So, like I said, you do the max, then you do the match. Then you do the HSAs, you do the Roths, and then you're like, whoa, I'm at the limit. Now what else do I do? There's all these different options. So what's next, Chloe?
Yeah. And just to clarify on that piece too, like if your income's high enough, you can put the $19,500 in the beginning. And if you still have extra money to save for your emergency fund, to pay off a high interest debt, do all the other things, then go ahead and max it out from the beginning and not just do the match. But you just it just depends on how much income you have and how much extra money you have to allocate to savings. But the next step would be a backdoor Roth IRA. And so that's what you do if your income is too high to contribute directly to a Roth IRA. So this is another way to get money into a Roth IRA account if your income's too high. Of course, we won't get into details, but there are some rules associated with setting up a backdoor Roth IRA. And there's also some tax reporting that's involved. And so you want to make sure that you understand those rules, that you understand the reporting that you need to do and the steps that are involved, and do that the right way.
For sure. So like I said, the backdoor Roth is another thing, all the rage for people. But like I said, I see it done wrong all the time, or people just going right through the front door when they should be going in the back door because they're DIY tax preparers. So they don't realize that you're not doing it in a way that is permissible, which can be a complete disaster to untangle when someone comes and they've been doing it for 3 or 4 years and, didn't realize that something was supposed to happen. So make sure that you understand whether or not you're eligible to contribute and whether or not the backdoor Roth strategy would be a more appropriate one if you want to contribute.
Yeah, and that is important that you said that. Like we said before, there's so many rules with all these different types of accounts. There's contribution limits, there's income limits, there's penalties, there's taxes, there's eligibility requirements, and so just understanding all of those things, it can be really confusing. And if you're just opening up accounts and contributing here and there and everywhere, and then you're mixing up money from different types of accounts, and that could be a disaster to unwind. So just try to make sure you understand, and if you don't, get some help.
For sure.
So the last category is a brokerage account. So after you've done all of the steps that we talked about above, then that's when it makes sense to set up a brokerage account. So, like I said, a lot of people start this in the beginning and they set up the brokerage account right away, and they haven't taken advantage of all the other types of accounts that we've mentioned before. And so, just make sure that you kind of have all those other steps taken care of before the brokerage account. So if your income is if your income's high enough, if you have enough extra cash, to save even more, then that's when you open up a brokerage account. It can help fill in the gap for saving and allow you to really get to the point where you're building assets and getting to the point where you're financially independent. So one thing I wanted to note here was that if your income is really high, you could be filling up all the buckets that we talked about before the brokerage account, and it could end up being maybe 10 or 15% of your income. And so, just when you think about how much money you need to save to actually be financially independent and get to the point where you work because you want to and not because you have to, if you're saving less than 10% of your income or 10% of your income, that's not going to cut it. People say, "Oh, I'm maxing out my 401k. I'm good. I don't have to save anything else." But no, you actually need to save more. And that's where the brokerage account helps you fill in that gap.
Right. I think that's such a good point. So you make $250,000. Hallelujah. Amen. Good for you. But 10% of your income is only $25,000. And we just talked about the maximum in that 401k being $19,000. So if you maxed out, you're not even at 10% of savings. And we definitely want you to have a savings rate, closer to the 20% mark. So that's where you, like you said, start considering some of these other options.
Yeah. And then, and so the last thing I will say is, we've excluded a lot of different things. Like we said, these are general guidelines, but there's things like on the debt side, there's things like car loans or student loans. On the investment side, there's other types of accounts. There's what's called a mega backdoor Roth. We won't talk about that. We don't want your head to spin.
Right.
But there's also employee stock purchase plans. If you work at a company that has an employee stock purchase plan for you to participate in, and then if you're a tech employee like people I work with, you might have some form of equity compensation like restricted stock units or RSUs and stock options. And so all of those things are not included in here. But and that's kind of when your life starts to get complicated. That's when it makes sense to get some help to really try to figure out how to best prioritize with all of the different options.
Yeah, those things go beyond the investing 101 sort of thing. And definitely, if you have stock options, you need to know and understand what your strategy should be, how to be most tax efficient in that process, how to, exercise those things. And like I said, Chloe is an excellent financial planner, if I do say so myself, working with people in tech and making sure that they are covered appropriately and that they have a good plan in place. So I'm gonna go ahead and do that shameless plug. All right, let's get to our final takeaways. What do you think, Chloe? How do we wrap this up?
Yeah, so I would say, I mean, the first thing is, just think about like what types of accounts make sense for you and just some of the guidelines that we gave. What does your situation look like? You can talk to all of your friends and you see things on social media, but it's important that you create your own plan and that you don't, just kind of follow along with what everybody else is doing. Everybody doesn't know your specific situation. And that's one of the dangerous things about all of this information at our fingertips. We can Google everything, we can look up information here and there, but the real like meat of it is just understanding how to apply that information to your situation.
Yeah, definitely. The investment of time, I think, also is a really important key takeaway. So, we were talking a little bit earlier about the idea of literacy and getting a good understanding, but investing time so that you can become literate is a key factor in all this. Like Chloe just mentioned, yes, we have information at our fingertips. So some people are like, I don't need a financial planner. I'm gonna listen to these podcasts for free 99. I'm gonna do a little bit of Googling after I finish listening to this, and I'm gonna be okay. And you totally may be. But you need to make sure that you're going to invest time, because you can't just look at the first article, go with what they say. That's the equivalent of doing what your friends are doing. You need to really understand before you go ahead and start implementing your plan. So that would be one other key takeaway that I would say is important.
Yeah, definitely. And one of the things that we talk about a lot is just getting rich slowly. A lot of these brokerage accounts that people set up and, before they're ready and before they've done all the previous steps that we talked about, it's a lot of it's just about getting rich quick and trying to flip your money, trying to, make your money work for you, whatever the buzzword is. But it's a lot of this is just really about trying to make money as quick as possible. And quick money and fast money doesn't always last. So, make sure that you understand what these accounts are, remember your goals, and contribute to these things so that you can get rich slowly.
Get rich slowly. It doesn't sound sexy, but it is a thing. It is important and it works. It so works. All right, let's go to our money quote. What's the money quote today?
Yeah, so today's money quote is, if you can't manage $1,000, then you can't manage $10,000. Financial literacy is not a side effect of wealth. Wealth is a side effect of financial literacy.
I love it. And I think it's such a good point. Like I said, for me, the word literacy means a lot because I know and understand what it means to be illiterate in something. So as you're on this journey to learn more about finances and to become more literate, you will create more wealth. But you cannot do that by not understanding, not knowing what's going on, and not investing the time in understanding or investing the time in getting someone to help you understand. So a teacher, a financial planner, coach, all of those are various ways to invest time in getting better educated. So
yeah, and we see it all the time. People go from making a small amount of money, or they go from growing up with not a lot of money, and then all of a sudden they're making several $100,000, and you don't just automatically learn how to manage that money right away. We see it all the time. We've talked about it in the past with athletes or entertainers or people that get millions of dollars handed to them, and then next thing you know, they're broke. So you have to make sure that you take that time, like Lauren said, to learn and to understand what you're doing.
Amen. All right. What do we have for the next episode?
Yes, I'm excited about this episode. So, we are going to wrap up part 3 of investing, and we're going to talk about the very trendy topic of rental properties. So I know that's something that a lot of people ask us about, and we really want to get into the details of what exactly how do rental properties work. When does it make sense for you, and make sure you understand what you're getting yourself into.
I can't wait. We've done quite a few episodes in the past with people who are actively investing in real estate, but this is all about understanding what does that even mean to use rental properties as a tool to be able to invest. So without further ado, if you have questions or suggestions for guests, or you want to share your money story, please do not hesitate to reach out. We've been getting quite a bit of fan mail lately. I'm really excited about it. There are people on the other end of this recording that are listening people that are interested in learning about the Know Better, Do Better series. So if you've got feedback for us, please don't hesitate to shoot it our direction. We are always looking to improve so we can know better and also do better. Until next time.
Bye.